As we've reported, we've seen a number of signs in recent months that the economy is slowing down. But just how seriously is it slowing? Joining me now to discuss that is Mark Serlin, economist for Bridge News. Welcome back, Mark.
Hi, Paul.
There have been some signs and a lot of talk about recession. Are we in one?
I think we are. I think it started with the auto industry. We had a run-up in gasoline prices. Then we had the Ford Explorer debacle that hurt the auto industry. Then during the last Fed tightening cycle, the stock market came off sharply. That prevented a lot of young companies from getting financing. Today we saw loan demand or financing standards are becoming more and more stringent. That's hurting companies' ability to raise money. And most importantly, all these factors have combined to put a major dent in consumer confidence.
All right, so you've told us how we got into this recession, if indeed we are in one. How do we get out?
I think the Fed easing is the primary issue. The whole issue with tax cuts certainly couldn't have come along at a better time, but it's up to the Fed, and they've responded aggressively, and the odds are they will be successful.
And how long a time period are we talking about to get back out of the recession?
Nobody knows for sure. We're likely to see some pickup in economic activity in the first, maybe second quarters. The result of more seasonal weather, warmer weather, will boost output and consumption. What happens after that, nobody knows for sure, but I think the market and consumers and businesses are going to respond to the sharp reduction in interest rates that the Fed's already arranged and will remain in an easing mode.
So it's the interest rate cut, not the tax cut, that will be the major factor getting us out.
The immediate impact will come from the Fed rate cuts. The tax cut is only going to help consumer psychology, and at the end of the day, it's the consumer confidence that really makes a difference. During the Asia crisis, consumer confidence never took the hit that it has now. What makes this crisis different is the dent in consumer confidence.
All right, Mark, thanks. We appreciate your thoughts on this.
Thank you.
My guest, Mark Serlin, economist, Bridge News. Friday's employment report will be another key indicator of what's happening with the economy. Joining us now with a guide as to what to look for in that November jobs report is Mark Serlin, economist for Bridge News, and welcome back, Mark.
Hi, Paul.
Do you think there will be adequate evidence in the numbers to support the view that U.S. economic growth is slowing so dramatically that an interest rate cut would be justified?
Perhaps the most important evidence to watch for is going to be the work week. Specifically, the work week's been trending lower for about a year. We're at the lowest level in almost 5 years, and if we move lower again, that's going to be of major concern because it suggests when economic activity does pick up, the work week's long enough that employers won't have to hire additional workers and bid wages higher.
Well, it has been actually on the wane. The last time you were with us a month ago, you said it probably will contract, right?
Yeah, the work week, and it's been trending lower. Now the uncertainty is how low does it go, and do we get confirmation? There's likely to be weakness in the auto industry. The key thing to watch for, do we get a weak services work week also?
All right, how about average hourly wages? I know you look at that closely.
Yeah, that's an important indicator. It looks like we might be increasing, going from 0.3% to 0.4%. The year-over-year growth rate is definitely going to accelerate.
Okay, are we going to see a move above that 30-year low of 3.9% employment? We're going to go to 4 or a little more?
People are looking for it. There, the thing you have to watch for is confirmation in the adult unemployment rate. Teenagers move the unemployment rate around a lot.
And as far as the interest rate cut possibility is concerned, what would the odds be, do you think, if you see a really weak report this time around?
I don't think they're going to cut anytime soon. What they're doing is going back to a neutral bias. Greenspan warned that this is not like the Asia crisis, so I think we're going to sit at neutral for quite a while.
Okay. All right, Mark, time's up, but thanks very much for being with us.
Thank you.
My guest, Mark Serlin, economist for Bridge News. This Friday, the government releases October's employment report. Joining me now from our Washington bureau with a preview is Bridge economist Mark Serlin. Mark, what should we be looking for?
The work week. The work week's the most important thing to watch for. It's a leading economic indicator. We've recently fallen back to 4-year lows. That suggests the need to hire more people is probably diminishing, but at the same time, it suggests very strong productivity growth.
Is it enough to cause an indicator that the economy really is slowing a lot?
If the work week continues to slow, yeah, it's going to get a lot of attention from the Fed because that work week plugs itself into a lot of other economic data.
Does this all translate into an increase, a decrease, or no change in the jobless rate?
Overall, the unemployment rate's likely to be unchanged, maybe inch a little higher, though. The unemployment rate's not the whole story, though. There's the labor force participation rate and the employment to population ratio. The thing to watch for is that they all move together. tell the same story of either labor market tightness or labor market weakness.
Is there anything that's particularly out of line with the other factors?
Yeah, right now the unemployment rate is suggesting that the labor market is very tight. The labor force participation ratio and employment to population ratio, they're suggesting that the labor market is loosening up a little bit. That's why I wouldn't be surprised to see a little uptick in the unemployment rate.
Okay, a little uptick in the unemployment rate, but you don't see the Fed being influenced one way or the other? That you think they'll hold steady for a while?
Yeah, I think they're going to hold steady for a while. The issue right now is strong consumer spending, a rebound in the housing market, versus a little problem with too much inventories and slowing in capital equipment spending.
All right, Mark, we'll be looking closely. Thank you very much. We appreciate your thoughts.
Thank you.
My guest, Mark Serlin, Bridge economist. Friday's upcoming September employment report will no doubt receive some close scrutiny for signs of a slowing economy after the Federal Reserve voted yesterday to keep interest rates unchanged again. Joining me now to look into what we might expect is Mark Serlin, economist with Bridge News in Washington. Welcome back, Mark.
Hi, Paul.
What should we be looking for in this jobs report?
Well, right off the bat, we know that more census workers are going to be coming off government payrolls, so that means attention should immediately focus on private. At the same time, we know there's about 75,000 strikers coming back, so the thing to look at is private payrolls, subtracting out 75,000. But the most important part of the whole report, I think, is going to be the work week. We've seen a very sharp contraction in the work week lately.
Yes, you predicted that on your last visit with me, yeah.
Yeah, and it's been trending lower, and if it continues to do so, it's going to be of major concern. As the data stand right now, it looks like the quarterly growth rate in total hours worked for the third quarter could actually be negative. That's a major sign that economic activity is slowing.
But yesterday, the Fed warned the labor market is tight. Isn't that right?
It did, and the labor market is tight in the sense that the unemployment rate is still very low, but there's other measures of labor market tightness, the labor force participation rate, the employment to population ratio. Both of those measures have come way off their cycle highs. That suggests that while the labor market is tight, it's not as tight as it was before.
Now, I know you look at something called the diffusion indices. What are they, and why should we look at those?
It's a measure that shows how broad-based any gains are. If payrolls are up a lot, but the increase in payrolls is concentrated in one industry, it's of less significance than if payrolls are up a lot and the gains are broad-based. So the diffusion index will show how broad-based any payroll job gains are.
Mark, how realistic is the Fed's warning yesterday that another rate hike just might be necessary because of the tight labor market and so forth?
It's a legitimate concern. Oil prices are going up. The main thing is, will the increase in energy prices prompt an increase in inflation expectations? If there's evidence to show that that is becoming the case, then the Fed will continue to tighten. But you have to remember, the Fed is in the central bank business, and their job is to be vigilant on inflation. So you would expect them to come out with comments like that.
All right. Interesting, Mark. Thanks very much. We appreciate your thoughts.
Thank you.
My guest, Mark Serlin, economist with Bridge News.